In today's show, we'll be looking at the economic calendar focusing on production and manufacturing, what's going on in the Far East, as well as the current situation between Iran and the US, all with Bob Mason from FX Empire. Hello, Bob, and thank you for joining us once again today. Let's start with Asia, if we can. How's it looking for the Aussie dollar and the Kiwi dollar? And what can our traders expect in the coming week from these two currencies?
For the week ahead, the economic calendar is on the busier side. It was pretty quiet over the Christmas period. So first up on Monday, it's focused on the pound. Key numbers are UK manufacturing and industrial production numbers. Focus will be on manufacturing production, which is the key driver for the pound. Really, it's, forecasts are negative, let's face it. And, judging by the December PMI numbers, it could be grim reading. New orders, new export orders slid, at the end of the year. And manufacturing sector activity fell to a 7.5-year low. So if those numbers are anything to go by, expect the pound to come under pressure on Monday. Later on in the week, we've got inflation and retail sales also in focus. Retail sales is set for a rebound. That's a must for the pound. There are hopes, obviously, that the UK economy is going to turn around. So, a boost in retail sales at the late in the year will be a positive. Trump's on the pound side. On Boris's side, Boris Johnson got his victory. So all in all, hopes are for a return to growth. From the US, we've got inflation and retail sales as well. Obviously, inflationary pressures are unlikely to move the Fed's outlook on policy. Retail sales needs to be positive and strong, however, to keep momentum in the US economy and maintain that optimistic outlook. Elsewhere, big week out of China, fourth quarter GDP numbers on Friday. That along with the industrial production numbers will definitely garner plenty of attention, at the end of next week. So yeah, busier week ahead. So expect plenty of moves in the market. But first up, it's the pound, and that's before we even factor in geopolitics.
With the UK elections now over and a clear and overwhelming victory for Boris Johnson and the Conservatives, which will mean the UK will leave the EU. But how will this affect the pound, and what effects will it have across Europe in general?
Last week, it was all about the withdrawal bill that Boris Johnson had managed to muster up and negotiate with the EU. Obviously, there was a change to the bill to limit the government from any amendments, essentially, and obviously remove the possibility of an extension to the transition period, basically ensuring that the UK Britain leaves the EU at the end of December this year. So 3 days of debate ended with a vote on Thursday. Assuming the vote, goes through with Boris Johnson's majority, the focus will then be on the EU and the member states, who have until the 1st of February to deliver their demands on trade negotiations. EU Commission President, visited London last Wednesday, raising more concerns over, the timeline they have to negotiate a trade agreement. That is reiterating her comments from, the holidays, where she essentially repeated the same thing. For Boris Johnson and the Tories, this bill essentially removes the chance for the EU to drag its heels once more. We don't need to see another 3-year period for Britain to gain terms to leave the EU. This time, a 3-year transition period would really hurt the UK economy, as we saw it hurt the UK economy going into the end of 2019. So expect the pound to be particularly sensitive. Obviously, the chances of a no deal Brexit remain, once the transition period is restricted to the end of December. But reality is the EU have a vested interest in having trade terms with Britain as well. Obviously key trading partners, so that's going to be key. So pound sensitivity, we're going to have another year where chatter is going to continue driving the pound. Market sentiment is going to be driven by EU member state comments on how progress is going on trade. Some will be optimistic, some will be pessimistic, and some will be unwilling even to form a trade agreement. So expect more volatility ahead. But as long as the UK economy is performing, and improving on an upward trend, and Boris Johnson making progress, the markets may stay relatively relaxed, at least through the first quarter, first half of the year. Panic stations, second half of the year should progress be limited.
How's it looking on the economic calendar? There was an increase in the stats to monitor, and with key stats due out on Monday in production and manufacturing, what can we expect from this?
A week ahead for the Aussie dollar. There's no major stats to really consider. Obviously, there's been some weak numbers out of Australia of late. There's been plenty of debate over whether the RBA is going to cut rates anytime soon. There was talk, obviously, in the last minutes of a review in February once they have their new forecast. With the extended period of forest fires, consumer spending is expected to be hit quite significantly. Obviously, employment may also be affected by a pullback in farming, etc., and tourism and the tourism sector. So the chances of a February rate cut are sitting at around 50% because of the forest fires. The RBA had been reliant upon consumer spending to support the economy. Obviously, there's some positive from the phase one trade agreement between the US and China to improve global trade conditions, but really from a domestic perspective, I think the forest fires have raised the chances of a rate cut. So upside will be limited for the Aussie dollar right now. The markets have got to wait till February for the RBA meeting and monetary policy decision. So expect focus on the stats in the coming weeks to make the Aussie dollar particularly sensitive. For the Kiwi dollar, electronic card retail sales and business PMI numbers are due out. We saw some impressive numbers out of New Zealand towards the end of last year. Business consumer confidence was on the up. Trade deficit narrowed, so it was all fairly positive, easing the chances of an RBNZ rate cut next month. In fact, sitting at below 20%. So Kiwi dollar is finding decent support. Obviously, much depends on global trade terms. The phase one agreement is a positive, but there's a phase two that's expected, and whether that can continue through and be rolled out before the presidential elections will be key, and how phase one impacts the economy through the first quarter. So plenty to look out for. Obviously, we expect the Kiwi dollar to be sensitive to the numbers in the week ahead. There's been a lack of stats over the last couple of weeks, so the markets will want to get a gauge on where things stand ahead of the next set of central bank meetings.
And lastly, on the geopolitical front, with impeachment talks still in the air in relation to President Trump, and with the recent events in Iran, how have the markets reacted, and how do you think they will react in the coming week?
Finally, on the geopolitical risk front, obviously we saw the de-escalation in the Middle East last week. Where do we stand? How will Iran respond to the olive branch that Trump reached out to try and lure the Iranian government into easing its actions in the region and to sit at the negotiating table? There's plenty to expect. Hopefully from a market perspective for the bulls, the government will take that invitation and pull back on its enrichment program. That will have to be an initial sign of good faith for the US government to consider sitting at the table, with the likes of the EU, Russia and China, to then look to roll out an agreement that meets Trump's requirements. That would be quite a coup for the US president. Obviously the 2015 agreement was frowned upon by Trump, so that was one of his campaign, key campaign messages that needs to be redone. That escalation, de-escalation, some might consider that a masterstroke, others consider that a breach of international law. There's been plenty of talk of whether that was an assassination, 2 Fridays ago, or whether it was an act of war. So let's see how the Iranian government responds. Obviously their retaliation was fairly modest, considering the talk, following the killing. So expect market sensitivity to any chatter. I don't think we're done quite yet. So let's see how things pan out. On the impeachment front, Trump's been sitting quite nicely, really, as the Democrats haggle it out with the Republicans on the terms of impeachment. The longer all this is delayed, the less material it's going to be from a market perspective in particular. Trump's unlikely to be ousted from office, so dragging out just the simple terms of impeachment, is raising questions on how effective the impeachment process is going to be for the Democrats. So all in all, it's been a good week for Trump. So let's see how things pan out through the first couple of weeks, in the next couple of weeks and in the first quarter. If Iran gets to sit at the negotiating table, and an agreement is reached, peace and prosperity within the Middle East will certainly be welcomed by the global financial markets.
Okay, Bob, thank you so much once again for joining us today. That was the week ahead, and we will see you again next week.